Good afternoon, everybody, and welcome to KBRA's COVID-19 webinar series focused on commercial real estate and CMBS. My name is Caitlin Colvin, and I run investor relations here at KBRA. We hope everyone and their families are staying safe and healthy during these unprecedented times. As events surrounding the COVID-19 crisis continue to unfold, our thoughts are with the individuals and families who've been affected by the virus. For those of you who may not be aware, KBRA is a global rating agency, and we have rated over $2 trillion in debt. Specifically, the CMBS team has rated over 500 transactions. I'm joined by Nitin Bhasin and Keith Kockenmeister, both senior managing directors and co-heads of KBRA's CMBS ratings team, as well as Roy Chun, managing director who runs the day-to-day surveillance operation. Nitin, Keith, and Roy will be taking you through the webinar. The slides from the presentation are available for download under the handout section of the GoToMeeting, and a recording will be circulated to all registrants after the webinar. We'll be holding time at the end of the presentation for Q&A. Feel free to submit questions through the GoToWebinar at any point during the course of the presentation. KBRA strives to be the most responsive rating agency on the street, and given these uncertain times, we know many want to better understand our thoughts on credits and markets. So please feel free to contact us with any questions at any time for additional clarity, as we're always happy to discuss. Also, many of you likely saw the Fed's announcement this morning that certain legacy issue CMBS will be eligible for the TALF program. KBRA is an eligible NRSRO for purposes of TALF, and we are able and willing to participate. So please feel free to reach out on that front as well. Without further ado, I'd like to hand it over to Nitin.
Thank you, Caitlin. I hope everyone is staying safe and following shelter in place and social distancing guidelines. Although the dilemma that we have today is the longer we stay at home, the worse the financial implications on commercial real estate will be. At KBRA today, today marks the start of week 5 of working remotely. Coming off fourth quarter 2019, there was tremendous enthusiasm for this year, and CMBS remained very active for the first couple of months. The marketplace was wondering what would be the catalyst for a downturn, and now we have it in the form of a black swan event. This is unprecedented, unexpected, and rapidly evolving. It is unique in many ways, and one of the ways this is different for our industry is that it is comprised of 3 discrete life cycles: the pandemic cycle, the economic cycle, and the real estate cycle. Unlike traditional downturns, where there are only an economic and real estate cycles, and CRE cycle generally lags unemployment, the economy and commercial real estate are being concurrently and directly impacted by the pandemic cycle. The longer the pandemic cycle lasts, the worse we expect the declines in the economic and real estate cycles to get. This is not a blip, and it is becoming increasingly evident that it is not going to be a quick V-shaped recovery. The inability to fully understand and control the pandemic cycle has also led to unprecedented uncertainty. Case in point is street GDP forecasts, for example. Not only is the average of the second quarter GDP forecast by 8 of the largest banks a staggering 20% decline, the range of that decline is from a 2% decline to 34% decline of those averages, which highlights the uncertainty levels we're dealing with. As such, the remarks that we make today are the best informed opinions based on what we know today and are likely going to evolve as the situation evolves. Over the next 30 minutes, we will be briefly going over our views on the major property types in CMBS, put forth some comparisons to the past to help dimension risks, and then dig deeper into what this all might mean in terms of rating surveillance and downgrade risks. We will then conclude with a discussion on new issuance and open it up to questions. With this, I will pass along the mic to Keith.
Thank you, Nitin. I echo what Nitin said as well. Thank you very much for joining us this afternoon, and I hope everyone is staying safe in these very unprecedented times. This slide analyzes COVID risk by property subtype using KBRA's rated book. Each bubble on this chart represents a sub-property type, and the size of the bubble represents its approximate exposure in KBRA's rated book. The property types near the upper right corner of the graph are, in our view, the most susceptible to COVID-19 impacts, and as a result are likely to experience greater spikes in delinquency rates relative to other property types. Conversely, property types in the lower left corner are likely to be least susceptible, although we expect them to also experience some amount of stress, particularly if the economic slowdown is deep and long. It should be noted that within some of the larger sectors, such as office and multifamily, there are property subtypes that will be impacted differently. As you can see, we expect lodging and retail to be at the most risk due to the COVID virus. We will discuss this further in the next few slides. Next slide, please. Let's start with lodging. The unprecedented decline in travel has led to the worst historical year-over-year RevPAR decline. For the week ending March 28th, year-over-year RevPAR declined by 80%. For the rolling 28 days, the largest drop in RevPAR for the top 25 markets was San Francisco, San Mateo at 83.1%, and the lowest was 57.2% for Norfolk, Virginia Beach. As a comparison, the worst weekly RevPAR decline post 9/11 was 38%, and it took 4 years to recover to the prior peak. And the worst weekly decline during the Great Recession was 25%, and it took 5 years to recover from that. In terms of sub-property types, the most impacted will be resorts with few people traveling on vacation, full-service brands, they're lacking both business and vacation travel, and convention hotels with all major conventions grounded for the foreseeable future. Urban locations faced with stay-at-home mandates are suffering as well, and airport locations due to the lack of travel. Impacted to a lesser extent are extended stay, economy, and those in lower density locations with less social isolation. We expect lodging loans to face a rapid rise in forbearance, modifications, and delinquencies. Major brands have already furloughed large numbers of employees as they attempt to reduce costs, as fixed costs will remain where they are, having a downward pressure on margin. As a 9/11 reference point detailed in the chart at the bottom of the slide, the lodging default rate increased from 3.6% at the start of 2001 to 13.5% in a 24-month span. We'll talk a little bit about more of that a little bit later. Next slide, please. Let's talk about retail. Retail has been severely impacted by the state-mandated near-total shutdown of many non-needs-based stores. A recent study by Credit Intel indicated that over 85,000 stores across 135 chain retailers have closed. Even stores that are open, such as restaurants, are generating a fraction of their normal revenue due to takeout, curbside pickup only. We expect credit loss to dramatically increase in the near term, and many retailers have already asked for rent relief in some form. Inevitably, the ongoing downward pressure on rents, occupancies, and value will escalate as tenant bankruptcies take hold. We expect the most impacted retail subtypes to be malls, outlet centers, strip centers, entertainment-based retail such as theaters and gyms, and assets with a high proportion of mom-and-pop stores and non-essential tenants. With regards to malls, if sponsorship was ever mattered, it's now. Those sponsors with deep pockets and access to capital with deep Rolodexes should be able to weather the storm better and have the ability to reposition struggling assets. Less capitalized sponsors may not fare as well. The less impacted subtypes should be anchored neighborhood and community centers anchored by grocery stores, pharmacies, and providers of essential goods such as dollar stores, Walmart, Target, and Costco. I'm going to hand it over to Roy Chun now, who will talk about multifamily, office, and industrial.
Thank you, Keith. While we believe that the long-term supply and demand factors still bode well for multifamily, the country has had an unprecedented level of unemployment in a very short period of time, putting many tenants at risk of not being able to make their monthly rent payments. In response, most states have instituted moratoriums on evictions. However, there's no corresponding relief provided to landlords. This puts borrowers in a tough position if a significant number of tenants are unable to pay their rent. On the positive side, Freddie Mac is offering 90-day forbearance program to their borrowers and those sold into their securitizations. The program is similar to the ones that have been offered to borrowers during natural disasters such as Hurricane Harvey and Hurricane Irma in 2017. If there's a prolonged economic downturn, it could impact rent growth. However, it could also make it harder for people to purchase homes, so it could result in expanded demand for rentals as it did in the last recession. Class B multifamily will likely fare better. Class A properties could see people moving down in class to save on rent, and Class C is much more susceptible to the type of renters most economically impacted by the shelter-in-place restrictions and a prolonged economic downturn. We do highlight in the slide the student housing and senior housing subsectors, as they have had supply and demand challenges even prior to the pandemic. And with the pandemic, they have their own unique dynamics that will need to be followed closely. If you go to the next slide. I'll cover office and industrial as well. Both sectors generally benefit from long-term leases and provide some buffer to the immediate economic disruptions. However, in the immediate term, tenants are requesting rent relief, and we will see collection losses increase as tenants struggle with their own liquidity issues and may decide not to make rent payments altogether. Also, the market is seeing a decrease in new leasing activity during this uncertain times. In the medium term, we do expect corporate bankruptcies to rise, and more prolonged recession will put pressure on rents and occupancy. Office-specific issues, co-working spaces have been immediately impacted as the members have been canceling agreements, have not made their membership payments in reaction to shelter-in-place rules and thus unable to use the space, or consultants losing business as corporations pull back on contracts to conserve cash. There are reports of operators negotiating the canceling of leases or changing to lease structures, including going to percentage rent or just asking for rent relief. In addition to the office concerns, there's those markets that are heavily reliant on oil and gas, and they are getting hit with a fall in oil prices on top of the pandemic-related issues. Longer term, we could see impetus to accelerate working from home as companies and employees figure out what works and what doesn't. On the industrial side, warehouse and distribution is expected to fare well with the online shopping increase, especially among the last mile distribution type facilities. On the other hand, logistics centers dependent on international trade could be negatively impacted as companies rethink their supply chain during the global pandemic. With that, I'll turn it back over. Next slide.
Thanks, Roy. Many of the conversations that we've had with market participants have revolved around how this crisis compares to others. While it's yet too early to tell with any degree of certainty, the following slides attempt to frame this discussion. Next slide, please. Let's first start off with giving a brief overview of KBRA's CMBS exposure. This slide displays KBRA's exposure in terms of property type and in terms of outstanding ratings. It's important to note that KBRA rated transactions represented approximately 50% of CMBS 2.0 deals. The bar chart on the bottom left of the slide represents KBRA's exposure in terms of property type. As can be seen, the top three exposures are multifamily, office, and retail. The vast majority of the multifamily exposures is within GSE deals. It is important to note the third and fourth largest exposures are retail and lodging. Two types we have indicated are at heightened risk of default and loan modifications. As indicated in research we put out recently, these asset classes are being very closely monitored by KBRA. The pie chart on the right side of the slide details KBRA's outstandings ratings by categories. It is important to note that 3/4 of our outstanding rated securities by balance are high investment grade, that being either AAA or AA. The next slide discusses high-level historical default and loss severities. Next slide, please. Much of the information displayed on this slide comes from our CMBS default and loss study, which is available on our website free of charge. The top chart on the slide details historical cumulative default rates by property type. As can be seen, office and lodging displayed the highest default rates as nearly 1 in 5 of these loans defaulted. We expect our lodging will continue this trend in the current crisis based on performance declines as we've previously discussed. In fact, we expect that default rate may eclipse those rates depicted on the chart. We expect retail default rates to be higher than those listed on the chart, especially for those loans collateralized by centers with a high exposure to department stores and other non-essential deemed tenants. The bottom bar graph represents loss severities by property type. As can be seen, while retail may lag office in total losses, of the major property types, it has the highest loss severity at 51.1. The office and lodging sectors were not far behind, with loss severities of 50.9% each. We expect similar patterns owing to the non-heterogeneity of commercial real estate. If the bottom of the crisis is not elongated, the losses could be less, but if the aftermath is deep, severities could be far greater. Now I'm going to turn it back to Nitin, who will discuss some of the characteristics of this crisis as compared to the Great Recession.
Thanks, Keith. Next slide, please. Unlike the financial crisis of 2008, which was triggered by excesses in the system, high leverage enabled by CDOs, SIVs, and repacks, the current crisis was triggered by external events. Also, the government response has been much more rapid now, which can change how the recovery happens. Unlike the prior crisis, when the incumbent rating agency methodologies were severely flawed, sounder methodologies and ratings processes exist now. Prior to 2008, for example, credit enhancement levels in conduit transactions declined as leverage IO and pro forma increased, and mezz debt was converted to AAAs using stale, misapplied, or unavailable methodologies. All of this is different and substantially healthier now. There were also missteps by agencies in surveillance and adjustment of ratings, with either too much or not enough downgrades, and with gaps in communication. At KBRA, however, we are taking a practical and pragmatic, credit-driven approach towards rating surveillance, which we will get into more a little bit later. We are striving to take measured actions where appropriate that are proactive, but not reactive or speculative. The rate of downgrades will escalate. It already has for some of the weaker deals, but the magnitude and extent of the downgrades will depend on the length and depth of the recession. We will be continuously communicating with the market via research notes, in-depth surveillance reports, and watch placements where practical. Next slide, please. This slide highlights one of the points I was making previously. The two graphs on the left plot conduit vintages from 2001 through 7, and the ones on the right present vintages 2012 through 19. The top graphs plot the average junior AAA subordination levels in gold, vintage LTVs in red, and historical losses as gray vertical bars. And the bottom graphs present the BBB subordination levels. In the pre-financial crisis vintages on the left, as I previously mentioned, the credit enhancement levels declined as leverage IO and pro forma increased, and the vintage losses on average ranged from 2.5% to 10+%. In the pre-COVID vintages on the right, however, the relationship between LTVs and CEs is more logical. Furthermore, the junior AAA CEs are 1.7 times higher than the pre-financial crisis vintages, and while the BBB CEs are twice as high. And this is in the backdrop of conduit loans now having 5 to 8 points lower leverage versus the older vintages. As such, we expect pre-COVID vintages to have lower losses than the pre-financial crisis vintages and meaningfully better ratings performance. Next slide, please. Next one, please. Now we'll jump into rating surveillance and downgrade risks that the investors might be exposed to in the current environment. In this graphic, the vertical left bar with slivers plots a conduit's capital structure. The box on the right shaded red and green depicts downgrade risk. Its x-axis represents different scenarios on how long the current economic disruption could last, ranging from a decline that lasts through this quarter to a decline that lasts for over a year. The dark red area indicates high risk of downgrades, while the dark green indicates a remote risk, with the in-between shades indicating gradations of moderate risk. As depicted in that graphic, we currently expect some investment grade ratings to be downgraded as data becomes available on a case-by-case basis. However, the longer and the deeper the recession, the risk of downgrades will rise higher in the capital structure. The severity of the recession depends on, among other things, how long the economic shutdown lasts. If we're entering May with no visible path of when and how we get back to work and how the economy gets restarted, many low investment grade and below investment grade classes could become subject of watch downgrade placements on a batch basis. In conjunction with reading this graphic, it's also important to understand what KBRA's ratings definitions mean and how our CMBS models and methodologies were calibrated. Our CRE stresses were calibrated in a manner whereby most BBBs should generally be resilient to losses under mild to moderate recessions. Not immune to downgrades, however. Single A's were designed to be generally resilient to losses under a slowdown that is equivalent to the Great Recession. Again, not immune to downgrades under such a scenario. The AAA's were designed to be resilient to downgrades under moderate to severe stresses. However, some AAA downgrades could happen on an idiosyncratic basis, especially in concentrated baskets of risk. Or a bit more broadly, if we do start approaching a Great Depression scenario. By marrying your individual views of economic outlooks with this graphic and the interpretation of our ratings that I just described, you can construct your own view on downgrade possibilities and timelines associated with it. For example, if the economic outlook changes to much darker and much quicker than what we know now, expect more downgrades than presented here. Conversely, if a quicker bounce back in the economy would lead to lesser downgrades. Next, Roy is going to dig deeper into our surveillance process and the tactical application for ratings actions.
Thank you, Nitin. As Nitin said, I'll take you through the surveillance process and how we're looking at deals now. We expect to maintain the discipline of our current surveillance process. We currently monitor news services and servicer notice. We review monthly remittance and service reports as they come out. None of this process will change, but we do expect that we'll see a lot more coming through these reports as we get deeper into this health crisis cycle and the resulting economic cycle. As with process, nothing will change about our surveillance review of a transaction. We will still redetermine net cash flow and LTVs from KBRA's perspective, identify underperforming loans and loans of concerns, and run the same models as we use today. In our report, you will still see loans for which we project a loss and the expected adjusted CEs. We will use watch placements wherever practicable and may even be more applicable now than ever, especially if we start seeing deals where a meaningful number of loans either have been transferred or noted in, let's say, watch list comments for seeking relief. We may not have the information to be able to take a rating action, but it's meaningful enough that we will put classes on watch placement. Watch placement is suited for such situations as they are early indicators of potential issues on the deal. In direct response to what's going on, we have been reassessing KBRA performance outlooks on loans and identifying loans of concern with a focus on retail and lodging. As a result, you will see many more loans being revised to underperform and identified as KLOCs. Underperform means a loan is not expected to perform at a level consistent with initial or recent performance, and KLOCs means that there is a heightened risk of default. As we have reported, malls and lodging are expected to underperform, and previously loans that were underperforming will most likely be KLOCs now. For retail and lodging loans that were previously performing, we will look to KLOC those on the more impacted types of properties as outlined by Keith when he covered these sectors. We won't repeat them here. If you turn to the next slide. As Nitin said, we're going to take a measured approach. At this point, we do not plan on taking broad watch or rating actions. However, this may change as we see how performance plays out over the next couple of months. Nevertheless, again, as Nitin said, we do expect there will be downgrades because of the economic issues caused by the pandemic. With that, I just want to touch upon some of the deals and what we can expect from us in terms of rating actions. On the SASB large loans, these are going to be case by case. Many of these deals are backed by sponsors that are better capitalized to carry the loans through a short-term disruption, but we do expect even well-capitalized borrowers may seek some kind of relief. Relief requests may translate into watch placements on some classes. As we hear about the requests, and if they are being considered, it will take time to see what is approved and how they may impact the trust cash flows. If there are defaults on payments, it will likely cause us to put at least some of the classes on watch. In either case, we wouldn't necessarily see a need to put all the classes on watch, as we may feel that the AAA classes or higher rated classes may be well supported by asset values. On the conduits, deals that have shown more stress will have the most immediate rating actions. And if you've been following our rating actions recently, we have seen in the past couple of weeks, we have taken down a number of deals where these deals already had a fair number of loans that were either in special servicing, underperforming, or KLOC assets. We'll closely follow actual forbearance, modification, and delinquencies on the conduits, and be prepared to put deals on watch as we see them happen in a meaningful way in each of the deals. Focusing on agency, we'll monitor the forbearance activity and may even put watch placements on classes and deals with high levels of forbearance. Although we do see it as a positive for renters and borrowers, there's no assurance that after the forbearance period, renters will be able to make ongoing or make up rent payments. If so, the landlord could be in the same place, but now with higher debt service payments because they have to pay back the forbearance over 12 months than the Freddie Mac deals. On the CRE CLO side, since these are generally transitional properties, we do expect at minimum there will be delays in borrowers' business plans. We will evaluate the loan performance in context of the different structural provisions and higher levels of CE in these deals. KBRA rated CRE CLOs, AAA CEs are generally around 40% and triple Bs are around 20%, so much higher than conduits. New deals not rated by KBRA may have more issues as they tend to have lower support, and because they are newer, they will not be as far along in their business plan execution. Next slide. Lastly, we want to touch upon servicing, as they are the ones that will be on the front line working with the borrowers. The numbers grow by day, but our last tally had servicers receiving over 4,000 requests from borrowers. I'm sure as we speak today, it's a much higher number than that. Other than the Freddie Mac program for their securitizations, there's no other broad programs for servicers to apply relief requests. They will be done on a case-by-case scenario. Master servicers or primary servicers are usually the ones initially working with the borrower, explaining process and screening for cases that warrant additional discussion. The role is important to pushing back on borrowers who may be asking for relief but may not have the support to show the hardship. This will allow all parties to focus on the most impacted assets. Master servicers are also responsible for advancing on defaulted assets, and if there are temporary forbearances similar to the Freddie Mac program. Advancing on loan modifications will most likely be dependent on the nature of the modifications. There may be modifications that impact payments that do not qualify for advancing, which could cause interest shortfalls to the trust. As it relates to special servicers, in most cases, special servicers are the ones that would handle modifications, even forbearances, unless the parties agree otherwise. Freddie Mac K deals are the exception, as those forbearances will be handled by the master servicer. A transfer to special servicer will generally include special servicing fees, and if modified or worked out, there would be an ongoing modification fee. If these are not collected from the borrower as part of the workout modification, then they would be paid by the trust and create shortfalls to the trust payment waterfall. That said, fees can be waived or reduced at the discretion of the special servicer, and we have heard from some of the special servicers that they would consider waiving or reducing fees in certain circumstances, but likely on a case-by-case basis. And lastly, there's still different issues that the industry needs to address if a consistent approach is desired. And just as one example, the CREFC IRP committee, which drives the reporting, performance reporting, is holding working sessions on how best to report on forbearance versus modifications and provide as much transparency to the market as possible. With that, I will turn it back over to Keith.
Thanks, Roy. Let's talk a little bit about the new issuance now. Next slide, please. We frequently get questions about outstanding and new ratings engagements. We are open for business. Nitin, do you want to give a little detail on that first topic?
Yeah, sure. We are open for business. Are we receiving sort of new engagements? While coming into this crisis, there is a heavy new issuance pipeline that grinded to a halt, but we're starting to see some green shoots as issuers are getting creative with pools, structures, and bilateral trades, and as they look to transfer risk that they're long. Has KBRA's analytical process changed? KBRA's methodologies, CMBS methodologies and models were built to analyze economic disruptions and to produce ratings in accordance with our ratings definition. And this is one of the big differences from the last downturn, where the methodologies were not built appropriately. As such, we do not expect to have any methodological changes. Our assumptions surrounding property cash flows and valuations will, however, reflect today's reality as it unfolds. Keith, you want to discuss that a little bit more?
Sure. As Nitin said, the methodologies and the process, those are not going to change. But cash flow, will we change cash flow assumptions? Sure. Particularly when it comes to credit loss and vacancies. We want to be more reflective of the stressed environment. A lot of store closings, a lot of tenants asking for rent relief, across all property types, but we'll be making those adjustments. It'll likely lead to higher PDs, LGDs, and CEs on a case-by-case basis. We'll be doing that. In terms of cap rates, these are built through the cycle. We've always told the market that there's a reason why we're 250 to 450 bips wide of market cap rates. It's for these cases right now that we're in. We have a range that's flexible enough to allow us to go up on a case-by-case basis if we feel that the situation warrants it. Will we apply additional PD or LGD stresses in the models? We'll do that as well on a case-by-case basis. Same thing with our KLTV thresholds for SASB and large loan deals. On a case-by-case basis, if we feel a pullback is warranted, we will do it. Nitin, what about loans that were subject to forbearance, modifications, and/or delinquencies, and what other additional information might we need to actually rate a transaction today?
Yeah, I mean, that's one of the questions we've received over the past several days. Are transactions with these kind of loans rateable? Yes, they're rateable. And we expect some of those will make it to transactions. However, there's some key points to note, right? Just, we do expect to get clean REMIC tax opinions and not watered down versions of those. And providing us information on the assets will be key. Both descriptive information and taped updates that give a fair picture of the current situation at the property, the tenants, their occupancy, whether they're paying rents, the loan's history, and the circumstances that led to the forbearance or modifications. It'll be a case-by-case analysis. For example, a temporary amortization forbearance on a lodging asset where the borrower is showing evidence of supporting the asset by making interest payments is totally understandable and may be treated like any other performing asset. Conversely, an asset where the borrower just cashed out and went delinquent or is seeking forbearance will likely be treated adversely, as these are indications of elevated default risk. Look, at the end of the day, the more information the issuers provide, the greater clarity we have on tenants, borrowers, and asset performance, and the general economic outlook, the more middle of the road assumptions we would use. We've also been asked, will NPL securitizations make a comeback? It's certainly possible. There are distressed assets, and some folks have been raising distressed debt funds. KBRA was one of the most active agencies in that space last time around, and all of those rated deals performed according to our expectations. We'll be happy to take those inquiries as they come in. With that, I'll open it up to any questions. Okay,
we have our first one coming in. Roy, this is going to be for you, I believe. The question is, are you proactively reaching out to CRE CLO managers to gauge their ability to buy back loans and honor future funding commitments?
Yes. So we have been reaching out to all the CRE CLO issuers and having a discussion with them about the current liquidity position on the future funding. One issue to kind of keep in mind is that as you know, the economy is the way it is, the future funding requests are lower, so the need for immediate future funding is not as great as it was before at the moment. But all the CRE CLO issuers that we have talked to have indicated no issues with liquidity and meeting their obligations under the documents, and they all have been reaching out to their respective borrowers, and similar stories as with like of the servicers, that most of the requests, most of the asks have been coming in from lodging properties. So, but still too early to tell what kinds of modifications will happen in these deals.
Thanks, Roy. We have another question. Is there any changes in approach methodology in terms of underwriting from rating agencies? We kind of touched on this just recently on the last slide with Nitin and I. There's no changes in methodology or approach. It's going to be in assumptions and our property cash flow assumptions. We're going to stress immediately collection loss, and it also may lead to a rise in cap rates on a case-by-case basis. We have another one. Nitin, I'm going to throw this one to you. And although you've touched on this, when can we expect any mass ratings actions?
Look, it's given these uncertain times, it's as we mentioned before, we're going to endeavor to take a measured approach, and the measured approach I'd kind of reiterate, right? It's we don't want to be reactive. We do want to be proactive, but however, not so proactive that it becomes speculative. So, the answer is it depends. If you're sitting another month, 2 months at home, and the economy is totally shut down, and businesses are shut down, depending on the transaction type and the portion of the capital structure, you could see, as mentioned one of the graphics before, larger scale downgrades or watch placements on the junior and mezzanine part of capital structures on assets that and transactions that are more heavily impacted. But again, this is dependent. This is like a three-step dependency, right? It's how long the pandemic cycle or the medical cycle lasts. Does it have a second bump in the fall, right? Some folks are talking about, hey, you might get like a second resurgence, right? Does that happen? How bad that is going to be? Or does this start to die down in the next few weeks, which is also one viewpoint out there? And what are the knock-on effects on the economy and commercial real estate? So it really depends, right? It's the views we shared today are based on what we know today, right? And things could change, are rapidly changing, and in a few weeks the situation could change quite a bit.
Thanks, Nitin. Next question we have is, how would KBRA conduct site tour on properties, especially in the top 10 to 20 loans? Obviously, at this point, we are not doing site visits. It's unclear when those will start up again. If we're still in travel restrictions at that time, then we will rely on appraisals. We will rely on Google Maps. It will have no impact on our analysis. We will still come up with property scores based on the information that is provided. This goes back to what Nitin said in terms of what it will take us to rate deals. It's going to take information. It's going to take clarity on exactly what kind of condition the property is in, and the most updated information that we get is the most reliable, obviously. Another question, either Nitin or Roy for this one. Any comments on the loss potential by geographies?
I think one of
sorry, go ahead, Roy.
the one that comes across and mentioned it earlier is the geographies that are dependent on oil. So you have both the pandemic as well as the fall in oil prices. Those markets like Houston will clearly be the most impacted. After that, it's I don't think in my mind anyone stands out more than another.
Yeah, I mean, I would add to that. Look, historically, the primary markets and the larger markets, while they may have experienced sort of similar default rates, they have experienced lower severities historically, and that's largely due to how diversified, let's say New York, for example, right? How diversified the economies are in these larger markets. So that has, while the declines of value declines in the larger and primary markets is no different than average, they tend to bounce back much quicker, and their next peak tends to be higher than secondary and tertiary markets. So in terms of severities, you could see that pattern still sort of panning out.
Great. I think we have time for a couple more. This one's for Roy again. What is your confidence of all the master services advancing while the underlying collateral is certainly lower LTV?
Yeah, well, pursuant to the documents, the master servicers are to advance until the appraisal reduction event happens, and then they have to see how much more they need to advance at that point. So obviously one of the issues is if there are delinquencies or modifications and appraisals have to be ordered. One of the concerns that came up in one of the service reform committees was just the potential rush or squeeze on appraisers to try to value properties in this market. So that will be an issue, but in terms of advancing, as long as the master servicer has confidence in the deal having the cash flows, they should consider the entire waterfall as they are on top of the waterfall. So I don't expect that there will be pulling back on advancing in the near term.
Great. Stay warm, Roy. I got another one for you. How will the percentage of loans in forbearance as a metric be reported in surveillance reports, in trustee reports, Bloomberg, et cetera?
Certainly, if we know of it and we can report on it, we will. Of course, won't necessarily have that field in it, but we will definitely report on it. And as mentioned before, one of the things that the industry is working on, and I think the third call is today, is just from the Cressy IRP committee. How do we make this transparent to the market, and how do you, for example, report on a forbearance versus any other modifications? And unfortunately, there's no code or fields that correspond to just the forbearance. So you have to use the codes that exist now, and generally people that you can't easily create a code and everyone change their systems to be reporting on it. So it's going to be a lot of manual effort in terms of getting the reports and going through them either through searches or manually reading through them. So it will be extra work.
Great. Thanks, Roy. Another one came in. I'll grab this one. Question was, what negative LTV adjustments will be used for rating SASB deals during the stressed environment? It's as I mentioned, we'll do it on a case-by-case basis. We certainly we'll be considering downward adjustments for lodging and for malls and other retail that has high exposure to non-essential businesses. It will probably be a negative adjustment to our base thresholds. We as per our criteria, we have base thresholds by property type, and it could be a negative adjustment down from that point, and it will depend on the structure of the deal. It will depend on the location. It will depend on how the asset was performing before the pandemic. These are all things that will be considered, which is why we have to take everything on a case-by-case basis. Nitin, I'll throw this one to you, and then I think we'll call it after this one. You seem reasonably happy that this isn't 2008 all over again due to lower debt levels. But how might things play out if landlords lose tenants and find themselves short of income to pay banks? Are investors holding enough cash for, say, a year's worth of interest payments or more?
Yeah, I mean, in CMBS transactions, there's a servicer advancing mechanism. There's certainly likely or possible that some assets or even a large proportion of assets in the near term are in a situation where tenants aren't paying rents to landlords. The first step there is for the landlord to come out of pocket, make loan payments. If the landlord or the borrower doesn't come out of pocket or cannot come out of pocket, that's where the servicer steps in. The servicer makes advances on those loans, principal advances, interest advances, property protection advances, taxes and insurance, capital items, items that will maintain the value of the physical quality and value of the asset. Those advances are eventually kind of reimbursed through the capital structure. But that's sort of the mechanism that like a several step mechanism that kind of protects the bondholders in CMBS transactions, and particularly the senior and mezzanine class bondholders who would be protected from the shortfalls in the short to medium term.
Great. Well, actually, we do have another one that I'll throw out as well. I'll grab this one. How will you treat deals where underlying tenants are no longer paying? How will cash flows reflect those tenants? This is similar to what I had mentioned before. On a case-by-case basis, if we're going to increase credit loss, we know that they're not getting the rents that they had been getting. On a case-by-case, we're going to look at it in a case-by-case. I've been reading situations where landlords and tenants are negotiating blend and extend leases, where they'll forbear the rent payment for, say, 6 to 12 months. They'll extend their lease the same amount of time and amortize the lost rent over that time period. And maybe in that case, the credit loss isn't as severe. It depends on the credit quality of the tenants and the sponsorship that's in place. I think those are the questions. Caitlin?
Oh, that's great. Thanks, Keith. Thanks to everybody for joining us this afternoon. We really appreciate your time, and we hope that everyone continues to stay safe and healthy during these unprecedented times. As I mentioned earlier, please feel free to reach out to the team or me with any questions. We're happy to discuss further. Thanks again for your time. Bye, everybody.